Hello everyone, and in this module we study chapter 9, the cost of capital. The learning objectives include sources of capital, cost of each type of funding, calculation of the weighted average cost of capital, construction and use of a marginal cost of capital schedule, weighted cost of capital. Compute the cost of each source of capital and determine percentage of each source of capital in the optimal capital structure. Calculate weighted average cost of capital, also called WACC. The first step is to compute the cost of debt. It's the required rate of return for creditors. It's the yield to maturity on bonds. For example, suppose that a company issues bond with a before-tax cost of 10%. Since interest payments are tax deductible, the true cost of the debt is after-tax cost. If the company's tax rate, the state and the federal combined, is 40%, the after-tax cost of debt is 10% times 1 minus 40% is 6%. Compute cost of preferred stock. The cost to raise $1 of preferred stock is equal to the dividend divided by market price minus flotation cost. For example, you can issue preferred stock for a net price of $42 and the preferred stock pays a $5 dividend. The cost of preferred stock is 11.9%. The third step is to compute the cost of common equity. There are two types of common equity financing. One is retained earnings or internal common equity. Another is issuing new shares of common stock, or called external common equity. Cost of internal common equity. Management should retain earnings only if they earn as much as stockholders' next best investment opportunity of the same risk. Cost of internal equity equals opportunity cost of common stockholders' funds. Two methods to determine. One is dividend growth model. Another one is capital asset pricing model. Cost of internal common stock equity. We use dividend growth model. For example, the market price of a share of common stock is $60. The dividend just paid is $3. The expected growth rate is 10%. The cost is 15.5%. We also use capital asset pricing model to calculate the cost of internal common stock equity. If the estimate beta of a stock is 1.2 and the risk-free rate is 5% and the expected market return is 13%. We use capital asset pricing model. The cost is 14.6%. Cost of a new common stock must adjust the dividend growth model equation for flotation cost of the new common shares. The same example, if additional shares are issued, flotation cost will be 12%. Dividend at present is $3 and estimated growth is 10%. The stock price is $60 as before. So the new cost is 16.25%. Gallagher Corporation estimates the following cost for each component in its capital structure. If the tax rate is 40% and 10% preferred stock and 40% of the capital structure is debt and 50% of them is common equity. If we use the retained earnings to finance the common stock portion, the capital structure, so the WACC is going to be 11.09%. If we're using a new equity issue to finance the common stock portion of the capital structure, the WACC is 11.72%. Marginal cost of capital. Gallagher weighted average cost will change if one component cost of capital change. This may occur when a firm raises a particularly large amount of capital, such that investors think that a firm is riskier. The WACC of the next dollar of capital raised in called the marginal cost of capital, or MCC. Graphing the MCC curve. Assume now the Gallagher Corporation has $100,000 in retained earnings with which to finance its capital budget. We can calculate the point at which they will need to issue new equity, since we know that Gallagher's desired capital structure calls for 50% of common equity. So the break-even point equals to the available retained earnings divided by percentage of total. Making decisions using MCC. Marginal weighted cost of capital curve can be divided into two sections. The first section using internal common equity, the cost is 11.09%. And the second portion using new common equity, the cost is 11.72%. Crowdfunding. Crowdfunding is a relatively recent phenomenon whereby companies raise capital from a large number of different people who have a connection with the company.